Hello everyone, this is Andrew McNair from SWAN Capital with our April 2024 SWAN Report. In this month's video, we're going to discuss some recent headlines that influence the financial markets, and what I want to do is distill all of this information and these perspectives and tell you what it means for your retirement, what it means for your portfolio over the next few months ahead. Now, as always, please stay tuned at the end of this video for a required disclosure statement. Now, at SWAN Capital, our market outlook has remained cautious. We look at the Buffett indicator, which compares GDP compared to our stock market. We look at the Shiller PE ratio that looks at the PE ratio of the S&P 500. All of them are red hot. And then we're also taking into consideration all these world conflicts, higher consumer credit, coupled with higher interest rates. We've talked a lot here about the expectations for the Fed to start cutting interest rates this year. Well, this month, the CPI, the Producer Price Index, both of them show inflation isn't dropping. Instead, inflation has crept slowly back up after dropping to 3% in June 2023. Now, the Fed wants to see inflation coming down before they start any rate cuts. We started out the year looking at possibly 6 or 7 rate cuts total. Now the market's just hoping for 1 or 2 rate cuts in 2024. Now, again, you know I've been very negative about rate cuts. I believe that because of the record inflation, we need to keep interest rates higher for longer and get used to some of these interest rates. But in March, it seemed the Fed would make its first cut at its June meeting. However, the chances of this happening have dropped significantly. Well, the reason is inflation has stalled between 3 to 4% and has remained stubbornly elevated for almost a year now. The primary culprit for high inflation, you see it at the gas pump, it's oil and gas prices. When those are higher for you and your family, it's higher for everybody. It costs more to produce goods. And that leads to higher prices for everyone in every product category nearly. So it's a vicious cycle, and it's one we've been stuck in for at least a year. As we know, energy is in everything. And for producers, when input costs like gas go up, prices also go up to make up for additional costs. And because of the bad policies coming out of DC, the war in Ukraine, I don't think anything's going to change anytime soon. If people are willing to pay, then prices will remain high. This can only go on for so long before people do start running out of real money and the cycle reverts back because businesses cannot sell the same things for the same prices. As a result, they make less and then they employ less before they cut prices. Then less energy is needed because they are producing less and theoretically have less demand for energy, which finally makes those prices go down. If we don't have a policy to stabilize volatility, it will be reflected in prices. And so right now it's contributing to a great deal of inflation, whether or not it's officially measured. Now, markets also have worried about the current conflict between Iran and Israel, and for good reason, and how Iran may continue to retaliate against Israel for its recent attack on the Iranian embassy in Syria. Now, Israel says more than 300 drones and missiles were launched their way by Iran, which is extraordinary, big assault, and it's one that we're keeping a close eye on because as the world braces for Israel's response, geopolitical tensions often lead to market uncertainty and volatility, and it only takes one major domino when the market's at an all-time high to knock over the rest. So investors may start to become more cautious, leading to more fluctuations in the stock market over an extended period. Now, the next few months may be more volatile, and I'm trying to warn you that it will potentially get very volatile soon. Then we would like to encourage you to review your portfolio risk. This is the time to make sure that you're properly diversified. You don't want to wait until the roller coaster ride starts dropping. We're at all-time highs, even for this year, still with all this volatility. So it's time to reconsider your 401k allocations if you're still working. It's time to make sure that you've properly invested in alternatives if that fits your accreditation with the SEC. That's why we have the Signet Fund to help clients have an additional layer of diversification. This is a time to look at the risk tolerance of the portfolios you're in. And again, we're taking measures here at SWAN Capital to prepare for any major pullbacks that may lie ahead. So again, the conflict will put more pressure on oil prices, and this was not a surprise. As we know, a lot of gas and oil comes out of the Middle East. So this will impact inflation if prices don't come down. That leaves the Fed with really two choices. They're going to have to decide if they're going to leave rates where they are and wait for the economy to slow down while hoping for a long and soft landing. Or B, they're going to have to raise interest rates again to stem inflation and potentially drive the economy, sadly, into a recession. Neither of these scenarios sounds like fun, and neither looks like it will feature rate cuts anytime soon. So I think we should get used to these rate cuts for longer periods of times. Now, there's the data that we need to talk about with the jobs report. The ADP employment report released just recently, and it showed that 184,000 private sector jobs were added in March. Industries that added the biggest numbers were construction, financial services, manufacturing. Meanwhile, the BLS, the Labor Statistics Report, reported 303,000 non-farm payroll jobs were added in March, mostly in the healthcare, government, and construction industries. So I'm glad to see that there is a mix of different industries that are adding jobs. That's a good sign. But the unemployment rate has stayed steady at 3.8%. All of this data says that the economy is still healthy, which seems like good news on the surface. However, it's continued cause for concern that the Fed will put off the rate cuts for longer. It's one of those things that we've been experiencing with clients that they have really got exhausted. The end consumer is exhausted with the years of inflation that have piled up. And so we're keeping a close eye on all of these metrics for you. That's all we have for this month's SWAN Monthly Market Recap. I want to thank you for listening to this report every month. If you have questions about your personal portfolio, you have questions about how this impacts your retirement, if you're a client, it's a good time to maybe push up your review if you're concerned about the economy. If you're not a client, but you need a second opinion on your portfolio to make sure that you're properly diversified while markets are at all-time highs, this is one of the greater times in history to do so. So give us a call at 1-800-848-8768. That's 1-800-848-8768. We'll talk to you soon, and we'll see you next time at next month's Monthly Market Recap.